We do believe we're on the right side of change, and disruptive innovation, transformative innovation is going to deliver exponential growth trajectories for many of our companies. In fact, most of them. The growth rates are enormous, and I think some people find them unbelievable. To give you an example, electric vehicles. We expect unit sales of electric vehicles globally, including China, to compound at an 82% annualized rate during the next 5 years. Most people, when they see a number like that, they'll just say, I don't believe it. It's not possible. And the reason for that, the reason we face that skepticism often, is because of where the automobile industry is right now. It's very mature. It's not growing. In fact, we believe it has peaked. And that means all cars are in secular decline if we are right that we are moving into more of a ride sharing, both human driven and autonomous during the years ahead. So this idea that electric vehicle sales could grow at an 82% annual rate, just not going to believe it. And so that skepticism festers, especially, I would say, among institutional investors whose analysts on the auto sector, for example, are mostly value analysts. So there are a lot of those disconnects in the world that are creating great opportunities for us. A lot of institutions are not set up actually to analyze a stock like Tesla. And I'm not saying all institutions, but I'm saying most institutions. And the reason for that is after the tech and telecom bust 20 years ago, almost to the day, March 10th, it started 21 years ago. And then on top of that, the 08-09 meltdown in the equity markets and the bond markets, there developed a lot of risk aversion, and volatility became a bad word. We have a volatile strategy, and we use that volatility to our benefit, trading around positions. Volatility is not a bad word in a bull market. Volatility, you've seen what happens in a down market. What has happened is institutions tend to be very benchmark sensitive. And I'm going to use Tesla as an example here. Tesla, as you know, many of you know, did not enter the benchmarks until last fall, when it was over $500 billion in market cap. So there was a lot of there were a lot of investment returns to have up to that 500 billion, and we were happy to be there. And we're happy that institutions are joining us now, but they're joining us primarily because Tesla entered the indexes. I'm not sure they really are trusting this. And the reason for that is their auto analysts tend to follow the traditional auto industry. And the traditional auto industry is very mature. And as I mentioned before, we think it's in decline. We are focused on exponential growth opportunities. We believe a sub-segment of the auto industry is going to see exponential growth for the first time in 100 years. And so that's our sole focus. Institutions have hired analysts to focus on an industry that is mature, and now there's a transformative, really revolution taking place that will alter the auto world completely. There was a lot of skepticism. The auto industry itself didn't expect electric vehicles to amount to much of anything I think they thought it wouldn't take until the mid-20s. Well, it's here. And we began to invest aggressively in this space on that assumption as we saw battery pack system costs decline as rapidly as they have been. The other difference between What ARK is doing, what a lot of retail investors focus on, is time horizon. I know that institutional investors are much more short-term, many, not all, and they're very focused again on the benchmark. So this idea of being graded every year based on how well an analyst or portfolio manager did relative to a benchmark is quite constraining. The third issue that institutions are grappling with, that we are not and that retail investors are not, is that the analysts are very siloed and specialized by industry or sub-industry or sub-sub-industry. That is just how the market evolved over the last few years. The problem with that is these new innovation platforms around which ARK has centered its research and investing are cross-sector in their ramifications. So it is the platforms that we have centered our analyst responsibilities on, and they are generalists, and all of them are comfortable with technology, very comfortable. Healthcare-oriented analysts, very comfortable. Industrial, you do not find that in institutions. And I truly believe that research departments in institutions will have to reorganize in order to invest successfully, or optimally, shall I say, in innovation going forward. Our analyst responsibilities, as I said, broken out by platform and technology. Chairman Powell of the Federal Reserve, I guess in a Wall Street Journal article, was not forceful enough, according to investors, in saying that we are going to keep interest rates down at all costs. I think a lot of investors wanted to hear him say, yes, we're going to try and control the yield curve. Well, by the way, that really has never worked in our country, so I don't know why investors would think that it would work this time. And he did note the disorderly market, although I think a lot of people misinterpreted some of what he said. We believe that interest rates going up, and it has been a shock when you think about it, going from 1% to 1.5% on the 10-year Treasury in the span of a few months is like a tsunami through the bond market, right? That's a 50% increase in yields. This is crazy talk in the bond world, but it's happening. And I think there's a lot of confusion and risk aversion, which has spilled into the equity markets. We'll take the other side of that trade. Interest rates going up, long-term interest rates, we believe are suggesting that real growth is going to pick up. Now, I know there's an inflation component there, and we are going to see the base effect of last year's drop in prices during the coronavirus. So we could see the CPI in the 3 to 4% range. It will be temporary. And we do believe that deflationary forces associated with disruptive innovation, and they're massively deflationary, combined with the deflationary forces of those companies who are going to be put in harm's way by this disruptive innovation and who have leveraged up too much historically, usually to cater to short-term oriented shareholders and to buy back their stock, not invest enough in innovation. They are going to have to cut prices ultimately in order to sell goods and service their debt. So I think those two forces are going to combine. Now, this isn't today or tomorrow. We think that today part is the deflationary undercurrent associated with innovation. But we do believe that as those forces come in and disrupt the traditional world order, this other source of deflation is going to occur. Fiscal policy, government spending is nothing more than future taxation in one shape or form. whether it's inflation, which is a regressive tax, whether it's outright taxation, which this administration seems to be veering towards. This is not good. Capital gains taxes, corporate taxes, tax rates going up. I think it shouldn't surprise the market. The fiscal policy, the fiscal stimulus has been in place for more than a year now, or for about a year now, and with that is going to come taxation. Well, now rubber's going to meet the road. We'll find out what kind. But I will say, the closer we get to next year, the lower the odds of some very harmful taxes, because we'll be looking into a congressional election year, and the House is very close in terms of the number of Democrats and the number of Republicans.